You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? This is Mike from The Moose and the Loose. I hope you're doing well today. Today, we're going to start this podcast with a quick trivia, a quick question on the stock that we're going to analyze. Of course, if you listened yesterday, you already know. But I just thought that it was quite impressive to talk about a company that I don't see much content to be created around it, and yet the business has been trading for almost 10 years on the TSX. Since its inception, it has outperformed the TSX 160% versus 126 since its IPO in 2015 in November. Over the past 5 years, that business shows a total return of 109%, so stock price plus the dividend, 109%, beating again the TSX 60 with 62%, so a pretty good beat. And the business is super stable, almost 25 billion in market capping, a yield of 3%, of course, a dividend grower, but very boring business model, very stable, generating tons of cash flow, strong balance sheet. So this business is Hydro One, ticker H.TO. Hydro One, super simple business model, all about transmission and distribution electricity. So for the distribution, we're talking about roughly 71% of the revenues are coming from the distribution, the balance 28% from transmission. But when you look at the EBIT, so the profit, it's mostly coming from transmission at 63% versus 37% for distribution. Hydro One, of course, based in Ontario, largest province in Canada, well-diversified economy, growing economy, strong population, a pretty good place to do business. The government of Ontario holds about 47% of all stocks, so mostly held by institutional investors, as you can tell. Maybe that's the reason why we don't talk about it too much, and the market is probably just, I don't know, a bit concerned about the power of a government over a business. And of course, in this case, we can totally get why. I live in Quebec. We do have Hydro Quebec. That is pretty similar to Hydro Ontario, Hydro One. But the difference is Hydro Quebec is 100% held by the government, while Hydro One made the jump in 2015 to go public. And it has been a pretty solid investment, but not at the beginning. So if you look at the stock price between 2017 and almost 2020, we were almost flat this entire time. So the only thing you would have had there is the dividend payment. But since then, since 2020, this is where the growth started happening, where the revenue keeps on growing. And maybe one thing that really helped Hydro One compared to other utility business that are pretty much struggling these days, right, is they have a very solid balance sheet. And they keep their payout ratio around 70 to 80%. So that's a pretty solid target. They keep on increasing their dividend year after year. So the 3-year and the 5-year dividend growth rate is at 5%. So 5.25 and then 5.15. So it's really, really stable. The yield is usually around 3% as well. So the current yield is at 3.05. The average of the past 5 years is at 3.20. So you can see that it's pretty much aligned. The payout ratio right now is at 65%, so plenty of room to grow the dividend. So what's their secret? How they can maintain a solid balance sheet and let's be honest, a pretty decent dividend growth rate at 5% year over year, even considering interest rate growing. Right now, the payout ratio has plenty of room to grow. The company generates enough cash flow to invest in their business on top of growing the dividend, which is always super important because it's one thing to increase a dividend, but if the business cannot grow their own assets, and they expect to invest between like 1.3 to 1.6 billion in assets in capex, per year until 2017. Well, that shows you that they have reached a pretty good balance between growth and share the wealth with shareholders, which is always something that I like as a dividend growth investor. The business model is super simple. 99% of their operations are regulated, which means that they have to deal with regulator. In this case, it's kind of interesting because the regulator is pretty much managed by the largest shareholder. So we're always dealing with Ontario government here. Of course, they're separate entities, but I mean, let's be honest, I'm pretty sure that the regulators and the government, sometimes they speak to each other, right? I'm just like saying this, maybe not. Maybe they're like completely independent and that would be fine. But anyways, in both cases, very stable business, predictable cash flow, and they know that when they invest more money to maintain their assets, to improve them, to generate more electricity, they will be able to increase their rate. So the expectation of growth is a EPS growth between 4 to 7% per year and a dividend growth increase of 5%. So still, what we have seen over the past 5 years is exactly what management intends to continue doing in the upcoming years until 2027 at least, which is pretty good because still we are in a place where interest rate, yes, will go down, but not like super fast. So for a business like this one, being able to tell you, you know what, we're going to keep growing mid-single digit throughout the next 2-3 years, it's a very good sign of confidence. And of course, it provides some stability. So if you're looking for income, you may be disappointed by a low 3% yield, but between you and me, I'd rather have a lower yield, but stable and a dividend that increases like year after year, than going from a higher yield with struggling business or a shaky balance sheet, which is not happening. So on the downside, like if there's any problem with this business, well, I would say that new projects, like new energy product, regardless if it's like green energy or not super easy to grow going forward. There are a lot of regulations. There's a lot of people that wants to protect the environment, which is perfectly fine, but that adds another layer of complexity to grow on that side. Hydro One also tried to grow in the US with the merger with Avista, but that was canceled by regulators in Washington and the state of Idaho as well. So sometimes it's not that easy to grow outside of your province. And one thing that, I mean, even though Ontario's province is really strong, really big, I always say that if you are focused on one single province or one single state, if you're an American company, it could create some dependency. And if there's a crisis in that province, well, then you're fully exposed. So this is what's happening for Hydro One. On top of being mostly controlled by the government of Ontario, on top of that, since they hold about 50% of all shares, this could be a problem in terms of like growth perspectives going forward. Not a big one. I mean, there are like some other bigger problem that could happen for a business, but those are two things that I'm not too sure what's going to happen in the future. Higher interest rates, of course, will continue to be a burden for all types of utilities because now the capex cost a lot more. Doesn't seem to be a problem right now for Hydro One, but it doesn't mean that you should close your eyes and never hear about it, never looked at it also. So overall, Hydro One, very interesting business if you want to sleep well at night investment. I think you should add it to your list. Take it a look. I mean, it's not going to be a company that will drive your portfolio through the roof, but sometimes it just feels good to have like those kind of like bond-like companies where you buy it, you forget about it, and then you just feel very comfortable having it in your portfolio no matter what happens on the market. I think Hydro One would make that cut. Full disclaimer, I do not have any shares of Hydro One, but I mean, seriously, that's kind of an interesting point Anyways, all right, guys, that's enough for today. If you want to have more ideas like this, I invite you to download the Dividend Rockstar list at moosemarkets.com/rockstars. It's a list that I use our heavily powered dividend stock screener at DSR, and I pull out all the companies showing revenue, earnings, and dividend growth positive over the past 5 years. So it gives you a pretty solid starting point. Not all companies on that list are great businesses, but it is a very good starting point for your research if you're looking to add a few more companies to your portfolio. All right, Moose, that's enough for today. We're going to talk again tomorrow. And tomorrow we're talking about strategy. So that's going to be fun. A little bit about like, why am I trimming my winners and like how diversification works in that area. So all of this tomorrow. So until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.